Bro, have you ever watched a stock suddenly go up like a rocket within minutes? And then the very next day, the same stock falls like it doesn't even care? Guys, we've all seen this. But what really causes it? Is it news? Is it traders? Is it FIIs? Is it operators? Or is it some secret formula? Friends, today you're going to understand the real truth. And once you understand this, you will never look at stock prices the same way again. Welcome back to WEALthmaama. In this video, we are going to break down one of the most important concepts in the stock market. Why do stock prices move every second? Why do some stocks rise while others fall? What is the force behind price movement? And we are going to explain it in the simplest, clearest, most beginner-friendly way. Let's jump straight in. The truth: every price moves because of people. Bro, this is the number one thing you must understand. Stock market prices do not move because of indicators, complicated patterns, astrology, your friend's tips, luck, operator manipulation, or some random theories. Stock prices move because of people. People like us. People like huge institutions. People like big traders. People like retail investors. Every time someone buys, the market reacts. Every time someone sells, the market reacts. Guys, the price is nothing more than a reflection of how many people want it versus how many people don't want it. That's the entire game. The whole stock market is basically a giant auction where millions of people place bids and offers. When more people buy, price goes up. When more people sell, price goes down. Friends, the price is just the scoreboard of buying pressure versus selling pressure. The dosa stall example. Let's use the same dosa stall example to make this super easy. Bro, imagine a dosa stall on a busy Sunday morning. The stall has only 10 dosa left. But suddenly 50 people show up wanting to eat. What happens next? People start pushing forward. People offer to pay more. Some say, Bhaiya jaldi de do. Some say, I'll give 5 rupee extra. Just give me first. The seller sees the demand increasing. So he increases the price. That's exactly how stocks behave. In the stock market, if there are more buyers than sellers, price rises. If there are more sellers than buyers, price falls. If buyers and sellers are equal, price stays stable. This dosa logic is not just an analogy. It is literally how every financial market works worldwide. From stocks to crypto, gold to real estate, everything follows demand and supply. Why do buyers increase? Great. So now we know demand pushes price up. But the real question is, why does demand increase? Why do people suddenly start buying a stock? Here are the main reasons. 1. Good news comes out. For example, company announces strong profits, a new large contract is won. Government announces a beneficial policy, a new product launch goes viral. Foreign investors put huge money into the company. When this happens, buyers think, bro, this stock is going to go up. I shouldn't miss this. Demand shoots up. 2. Positive market sentiment. Sometimes even when there's no major news, the whole market feels bullish. Guys, this happens often. Nifty goes up. Global markets are green. Investors feel confident and suddenly people start buying everything. 3. Fear of missing out. FOMO. Bro, this is real. Let's say a stock jumps 5% in the morning. People see the green candle and think, Arey, the stock is running. If I don't buy now, I'll miss the rally. Demand spikes even more. Charts show this as strong green volume. 4. Big investors start buying. When mutual funds, FIIs, or big institutions buy a stock, retail beginners also rush in, thinking, big players are entering, something big is coming. Demand increases, price climbs. Why do sellers increase? Just like buyers increase due to positive reasons, sellers increase due to negative triggers. 1. Bad news. Examples: company posts loss, management resigns, fraud allegations, government bans something, product failure, global crash. When this happens, sellers think, bro, get me out now. Supply increases, price falls. 2. Panic selling. Guys, fear spreads faster than confidence. Sometimes the whole market falls because Dow Jones crashed overnight, oil prices rise, war tension, inflation news, RBI policy changes. Even good stocks fall during panic. 3. Profit booking. Even when the stock is good, people may still sell to lock in profits. Example, stock goes from 100 rupee to 130 rupees. Traders think, 30% mil gaya. Let's book profit. They sell. Too many sellers, temporary fall. 4. Stop loss triggers. Bro, this is important. When the price falls below support levels, stop loss orders get activated, which creates automatic selling pressure. More sellers is equal to sharper fall. The bid and ask fight, the real battlefield. Guys, now let's go deeper, because this is the engine behind price movement. Every stock has two major types of orders. 1. Bid, buyer's price. This is the price buyers are willing to pay. Example, I'll buy at 100 rupees. I'll buy at 101 rupees. Bro, I want it quick, so I pay 103 rupees. 2. Ask, seller's price. This is the price sellers want. Example, I'll sell at 103 rupees. I'll sell at 104 rupees. Now here's the magic. Whenever a buyer agrees to pay the seller's ask price, the trade happens, price moves. Whenever a seller agrees to take the buyer's bid, trade happens, price moves. The entire stock market is like a never-ending tug of war. Buyers pull up and sellers pull down. Whoever is stronger wins. If buyers overpower sellers, the price rises. If sellers overpower buyers, the price falls. Friends, once you understand this, you basically understand 80% of stock market movement. Live example. Let's take a stock trading at 100 rupees. Suddenly the company announces great quarterly results. Here's what happens step by step. People see the news, buyers rush, bid prices start increasing. Buyers say, I'll give 101 rupees, 102 rupees. Bro, take 104 rupees. I want it now. Within minutes, price jumps. Now imagine after 2 days, the company gets negative press. Sellers panic, sell at 103 rupees, sell at 102 rupees. Bro, just pay 100 rupees. I want to exit. Supply increases, price crashes. This is not magic. This is pure demand and supply. Why this concept is everything? Guys, trust me. When you understand demand and supply, you understand breakouts. You understand breakdowns. You understand support and resistance. You understand volume. You understand trend reversals. You understand operators' tricks. You understand market psychology. This one concept is the brain of the stock market. Everything else you learn later is just a bonus. Pro tip for beginners. Bro, here's the smart thing you can do. Whenever you look at a chart, ask yourself these 3 questions. Are more people buying than selling? Is volume supporting the move? Is the trend natural or emotional? If you get these answers right, your entries and exits will improve dramatically. Friends, trading becomes easier when you stop chasing candles and start understanding people. Guys, I hope this explanation made stock movement super clear and super simple. If you found this helpful, hit like, drop a comment, and subscribe, because the next video is absolutely crucial. What is Nifty? What is Sensex? Full breakdown for beginners. Bro, once you understand Nifty and Sensex, you'll finally know how the whole market moves. See you in the next one.